In 2008, the global economy nearly collapsed. Banks failed, millions lost their homes, and over 8 million Americans lost their jobs. Governments had to spend trillions of dollars just to stop total financial disaster. But how did the most advanced financial system in the world break down so completely? The answer is simpler than you think, and it starts with something that sounded harmless: cheap money. In the early 2000s, interest rates were very low. Borrowing money was easy. Banks were approving mortgages fast. You wanted a house? Approved. Bad credit? Approved. No proof of income? Approved. These were called subprime mortgages, and banks didn't seem worried because housing prices were rising fast. Everyone believed one thing: home prices would always go up. That belief changed everything. Banks didn't just give out these risky loans, they bundled thousands of mortgages together and turned them into investment products called mortgage-backed securities. Investors around the world bought them because rating agencies labeled many of them as safe. But inside those bundles were risky loans. When homeowners started missing payments, the system began to crack. Interest rates increased, monthly payments went up, and many borrowers simply couldn't afford their homes anymore. Foreclosures exploded. More houses flooded the market, prices started falling, and suddenly people owed more on their homes than the homes were worth. Defaults spread faster and faster. Those safe investment products were no longer safe. They were toxic. Banks were sitting on billions of dollars in collapsing assets. Then September 2008 happened. Lehman Brothers, one of the largest investment banks in the world, collapsed. Panic spread instantly. Banks stopped trusting each other. They stopped lending. And when banks stop lending, businesses stop operating. Companies couldn't borrow money to pay employees. Markets crashed. The entire credit system froze. This wasn't just a housing problem anymore. It became a global financial crisis. The government stepped in with massive bailouts. Hundreds of billions of dollars were injected into major banks. The Federal Reserve cut interest rates to nearly zero and began printing money to stabilize the system. But people were angry. Banks were being rescued, while ordinary families were losing their homes and jobs. That anger still exists today. So what actually caused the crisis? It wasn't just housing. It was excessive risk, blind optimism, and a system built on short-term profits. Banks made money by issuing more loans. Investors made money by buying risky securities. Rating agencies made money by approving them. Everyone benefited, as long as prices kept rising. But the entire structure depended on one fragile assumption: that housing prices would never fall. When that assumption collapsed, everything collapsed with it. The 2008 financial crisis was not an accident. It was a system-wide failure driven by greed, leverage, and misplaced confidence. Financial systems run on trust, and when trust breaks, the consequences are massive. That is what happened in 2008.